Namaste to all. I welcome you all to another panel discussion hosted by the Accounting Standard Boards of ICI, and a very, very important topic, which is in relation to the accounting of property, plant and equipment, which in the common parlance, some of our members or even the public at large talks about as a fixed asset. So this discussion on property, plant and equipment, I hope would be very, very interesting because it takes into account various important things, that what is to be capitalized, what is not to be capitalized, to the extent of what is a capital asset and all those things. And for this today we have a very strong panelists. We have got CA Rajkumar Agarwalji, who has got more than 30 years of experience. He's a fellow chartered accountant from the 1991 batch, and he's also Bachelor of Commerce from the Ajmer University, and he's also done his certificate course from ICI on Ind AS, also course of ISA, CAT, and many others. Also, he has been into the practice of audit earlier with the Haripatti, now with the Saxena and Saxena, and he has been a regular contributor to our institute, and also is a faculty on the Ind AS certificate course issued by the institute. So I welcome Rajkumar sir, and I am hoping that all the participants would be benefited by our deliberations today. Welcome, sir. Also we have CA BL Sharma ji, another prolific speaker and contributor to the ICI. He's got more than 10 years of experience. He is currently into one of the big four entities, EY. And apart from his chartered accountancy, BCom, he has done IFRS from the ACCA and has been a regular contributor to the institute and writing a lot. He is also a regular speaker at our Ind AS certification course. And again, I feel that our members would be enriched by your knowledge today in the discussion which we are having. So welcome, B.L. Sharma sir.
Thank you, sir.
We have got a young and energetic moderator today, CA Astha Gupta, who is, I would say, when she moderate and speak, we all will come to know that the qualities which she has, the depth in that study which she has on the AS and the Ind AS. Today she'll be covering, moderating the topic of the property, plant and equipment. So welcome, Astha ji, and thank you for being readily available to moderate this very important session. And in absentia, our Vice Chairperson, C. Abhay Chhadev ji from Bhopal, because he is traveling, so he will not be able to join. So let us set the ball rolling, and I'll request C. Astha Gupta to take it forward to have the discussion.
Thank you, Pramod ji. A very good evening to respected Chairperson Pramod ji, our respected panelists, and the audience present in today's webinar. Before I start this webinar, I would like to extend my heartfelt thanks to the Accounting Standard Boards of the ICAI for bestowing upon me this wonderful opportunity to moderate this panel consisting of such knowledgeable minds. Thank you so much. Today's topic will be the issues related to accounting of property, plant and equipment. The webinar will be in a question and answer format, wherein I as a moderator will be posing pre-drafted questions with our respective panelists, and they'll be answering. The audience is welcome to contribute the questions during the course of the webinar. Depending upon the timing, we will try to address them to our best of our abilities. So without any further ado, I would like to address my first question of this session to Rajkumar ji. Prior to 2016, the Accounting Standard 10 was known by the name for Accounting of Fixed Assets. What was the background behind changing its name from Accounting for Fixed Assets to Accounting for Property, Plant and Equipment?
Thanks, Astha. Good afternoon, all my fellow chartered accountants. Thanks to the Accounting Standard Board, my fellow panelists, and our chairman, Mr. Pramod Jain, for this opportunity. Asta has asked that earlier the name was fixed asset, and I think most of us have in our mind fixed asset, fixed asset, fixed asset. So yes, a very small but very pertinent question. From the point of view of learning, I can tell you, sometimes history also guides us very nicely, and it goes inside our mind. So therefore, there is a small amount of history and very interesting history, which will make you understand from where, how, and where we moved from fixed asset to PP. So it all starts basically from the convergence of IFRS to Ind AS. The first point where the word or the nomenclature PPE came into existence for all of us. So therefore, as you know, and that in April 2016, there was a notification with regards to adoption of Ind AS, and accordingly, the MCA notified had the notification. So therefore, when we converged IFRS to Ind AS, this particular standard was not named as fixed asset. I mean to say, the nomenclature was not used as fixed asset, what we were using, but it was changed to PPE in line with the international standard, that is IFRS. Now, our original AS were named by name of fixed asset only. The name was fixed asset only. So there was an exercise by ICI to bring in line the AS with the Ind AS or IFRS as we call it. So therefore, in March 2016, the fixed asset standard was revised and notified, and therein the word used was PP. So that is the small history. But we have to also locate it. The more interesting part is we have to locate it from the point of view of the Companies Act, because companies are our major financial statement, what we do. So therefore, when the notification with regards to Ind AS was there, you know, the division 2 of Schedule 3 was introduced. Division 2 is with regards Ind AS. So therefore, there it was division in the division 2 of Schedule 3. The words and nomenclature used was not fixed asset but PP. Now, if you can understand, there is one more remaining part. That in Division 1, which was our original balance sheet, still the word fixed asset was there. So therefore, in October 2018, there was another notification from MCA which contained that now on the fixed asset is now replaced with PP. There is another amendment, very interesting one, which is in the CARO. So we'll touch that upon maybe in the discussion today. In CARO, the first question, whether the particulars of fixed asset has been maintained or not, that has been changed as PP with the last notification in 2020. So that is the small history how we moved from fixed asset to PP. So let us now forget fixed asset. Now let us all say PPE, property, plant and equipment.
Rajkumarji, thank you for walking us down the history of evolution of accounting standard. Very interesting, you've explained us how it has evolved from fixed asset to PPE and how we as professionals need to forget fixed asset and move on to property, plant and equipment. Thank you so much. Continuing in this question only, Pramodji, has the same changed for non-companies also, or it is applicable only to companies?
Very good question, Astaji, because many a time not only our members, even businessmen, they feel that because the financial statements are to be prepared by the businessmen, so they feel that it is fixed asset. But it is pertinent to note that even for the proprietorship partnership and that is non-companies, the accounting standards has been amended. So for them also now it is AS10, and when AS6 was omitted and depreciation was put into AS10 itself. So now we have property, plant and equipment even for non-companies. So if in your financial statements you are putting the terminology as fixed asset, I request that when you prepare the financial statement for proprietorship, partnership or audit, when we audit it, let us ensure that the terminology which is used is property, plant and equipment. And just for the information of all the members, the board is in the process of bringing out the formats for the financial statements for the non-companies. Currently, the formats for the companies are there in the Schedule 3, as pointed out by Rajkumar ji, Division 1, Division 2, Division 3. But for the non-companies, that is proprietorship, partnership, etc., there is no specified format. So ASB is in the process to standardize the format of the financial statement for the proprietorship partnership, which would be in the line of Division 1 of Schedule 3. More importantly, basic things would be about current year and previous year, both are to be given, and assets and liabilities have to be bifurcated into current and non-current. So we are hoping that it would be passed by the board very soon. So we request all the members who are listening and to tell to others also to comply with the same format for all proprietorship partnerships and others other than companies, so that the format of the financial statements are standardized. And there also we'll have to use the terminology as property, plant and equipment, because AS10 also has been amended for the proprietorship and partnerships.
Thank you, Pramodji. I think this is a very important and good move on part of the ASB to develop this format for non-companies. I think it will bring out uniformity for financial reporting purpose. So,
great. Thank you. Your network is there. You may switch off the video and then try ask them.
Okay. Am I audible now?
Yeah, fine. Yes, great.
Okay, I'm sorry. This question is for CABL Sharma ji. Which assets are not covered or excluded in accounting standards for PPE?
Yes. Thank you, Asta ji. Thank you so much, Chairman ASB, and my fellow panelists, Sir Rajkumar Agarwal ji, and my all CA colleagues out there. And I'm really privileged to be part of this panel. Welcome all of you. So to answer this question, Asta ji, as per under the AS say all the property, plant and equipments are covered under the AS, except few which are deal by the other standards. And similarly in the Ind AS as well, that all properties are covered except few properties and few assets categories which are dealt by the other standards. So if I first talk about the AS, so under the AS only there are only few exclusion is given up regarding this, and that is bearer plant biological assets. So under the biological assets, except bearer plants. So bearer plants are included in the property, plant and definition, but apart from bearer plants, so under the bearer plant also they have defined, standard is defined the definition of bearer plants, and that it is used for the produce of produce for more than 1 year agriculture produce. Like let's take example of tea plants, tea bushes, and fruit plants, so and oil palms, oil, etc. So all these are included in the PPE. However, the biological assets are excluded from the definition of PPE. Apart from this, if we move further, then there is like minerals, resources, minerals, oil, gas related, like the assets which are covered under. If I talk about the Ind AS, then standard covered by 106, recognition and measurement of exploration and evaluation of assets are excluded from the Ind AS 16, and then mineral rights and mineral reserves and oil, natural gas, and similar non-regenerative resources are excluded from the Ind AS 16. However, the standard says that these parts are excluded from the Ind AS, but the assets which are used for develop and maintain these class of assets are to be covered under the standard and are to be part of the PPE definition. Yes.
Okay, thank you. My next question is for you. How is Ind AS 16 different from International Accounting Standard 16?
Yes. So, if we see the Ind AS and IS 16, there are no differences between these standards. However, there's one small difference around the valuation of investment property. So, under the Ind AS, valuation of property, and if valuation of property under the cost method, then Ind AS says that it should be valued according to Ind AS 40 only. However, under the IS says that it should be valued according to the IS 16. So cost should be valued according to the IS 16 only. So this is the only basic difference, I would say, because there is a fair value and cost, both approach are allowed. So that is the only difference. However, apart from this, there is no difference in the IS and in the 16.
Thank you, Veer Sharma ji. It's a matter of pride that we've almost, adopted the international accounting standards for our Indian entities, except for the small difference that B.L. Sharma ji has highlighted. Thank you. Rajkumar ji, like way in which B.L. Sharma ji has highlighted difference between Ind AS and International Accounting Standards 16, what is the fundamental difference between AS 10 and ICDS 5? Sorry, and AS 16?
Thanks, Asta. So you have asked that what is the primary difference between AS 10 and Ind AS 16?
Yes.
Right. Okay. So I'll answer this question in this way. So whenever as a faculty I've been asked that what are the gap differences. So normally I understand there are 4, 5, 6 gap differences. But when actually a person goes and sees the standards side by side, there are a lot of differences, and one is mostly confused. So I'll take 2 minutes for answering this. So I'd like to answer this question in this way. So what are the differences between the 2 accounting standards, AS and Ind AS? So first difference is look and feel. Let us understand first how the look and feel, because that is the first impression that we get. So, friends, you have to understand that in Ind AS, there is a concept of objective definition, and then the standard runs, then the last disclosures are there. Together with that, there are appendix, and also there are appendix ABC, and there are appendix 1, 2, 3. So the first look and feel differences in Ind AS, you'll find appendix A, B, and C, and appendix 1 in case of AS 16, Ind AS 16, but in AS you'll not find this appendix. This is the look and feel difference. Second, whenever an accounting standard is there, there is always a transition paragraph always given. What has happened is in Ind AS, all the transition has been clubbed at mostly one place, which is 101. So therefore, in Ind AS, all the transition issues are addressed in Ind AS 101. Whereas in AS 10, all the transition problems or the transition guidance is given in the accounting standard itself. Because as you know, in AS, we don't have any, we are still to rather adopt or converge to the entire standards. So therefore, the transition, particularly for fixed asset, is given in the standard itself. This is the difference between transition provision. Now, the another big thing which I would like you to hear about is what is the difference because of the other standard impacting the formation of AS 10. So friends, what is happening is, like say suppose there is a standard called 105, non-current asset held for sale and discontinued operations. Okay. Now the comparative AS for it is the what you call AS 24, discontinued operation. Now wherever there is a reference given for all these 105 in Ind AS and AS 24 in AS 10, so that is where it is. That is where the difference is. Now the nomenclature which is used for a valuation of the property or the recognition or the measurement of the property, broadly the concept is the same. So therefore in AS 24, where it is discontinued operation, we take it as lower of carrying amount and NRV. And whereas in Ind AS, we take lower of carrying amount and fair value, less cost of acquisition. So basically, the principle is the same. Similarly, there is an investment property, Ind AS 40, and whereas we have AS 13. So the reference and what is the nomenclature, that is where the difference is. We have a different accounting standard, Ind AS 41 for agriculture. Some of the provision of Ind AS 41 have been incorporated in AS 10 to reflect that, because we do not have an independent agriculture related AS. Moreover, one interesting aspect which I think you'll all encounter is fair value is a very important concept in Ind AS. There is a separate and detailed accounting standard, AS 113, which gives the guidance on how the valuation should be done, whether the valuation is by registered valuer or whether it is by any other valuer or by the management. Since we do not have the equivalent account AS still, so therefore, for the reference, it is given that wherever the valuation is referred, it is said in AS 10, that is the PP which we are discussing, that it should be valued by a competent valuer. Competent valuer could be registered valuer or whatever it, and competent valuer would of course follow his standard, and he'll also follow AS 130. So basically, it gives the basic fundamental that the valuation would be as required. Then certainly there is reference for 116 Lease and other related standards. So these are the differences that you'll find when you read both the Ind AS and the AS. But let me come to the actual difference. When I call the actual gap difference, see, we are to bring the AS in line with the Ind AS, which are converged of IFRS. So fundamentally, there is no difference except for one clause of stripping cost, where the guidance is given in the Ind AS, but it is not given in AS. Last but not the least, since we have drafted the AS after the Ind AS, it has been bit Indianized. Say for example, inauguration cost. Now, inauguration cost in India is very common. The word inauguration cost has been incorporated in the AS itself, so as to say that inauguration cost would not be capitalized. Similarly, administrative buildings. We have a lot of so that particular part is also referred. Then there is one of the item that sometimes what happens is a project can be an item. So therefore, that particular item has also been incorporated. So wherever to make easy or wherever it is required to clarify or wherever it could be potential issue, all these things have been incorporated. But when you read and apply, both the standards are the same. For fundamental, your working, you can tell it that it is same. Look and feel a bit different. Transition provisions are there. Due to other Ind AS, the reference are changed and actual differences vary. That is my thought.
Thank you for such a detailed explanation, Rajkumarji. Taking these comparison questions to the next level, Pramodji, what is the difference between AS 10 and ICDS 5? Pramodji, you're on mute.
Another good question out here, because these ICDS are applicable not only to non-companies but even to companies. So at one place, the companies have to comply with the AS or the Ind AS as may be applicable, the company's accounting standard rules 2021 or Ind AS. They also have to comply with the ICDS, which is not for the purpose of recognition or measurement or disclosure in the books of accounts, but it is for the purpose of computation of income and disclosure in the income tax audit reports and computation of income thereof. The title itself talks about it because my AS 10 is property, plant and equipment, and in AS 16 also property, plant and equipment, but ICDS 5 V, we say ICDS V, or in the normal parlance we say ICDS 5, that is tangible fixed assets. So that is the old tangible fixed asset which was there in the erstwhile AS10. So what did the CBDT do to make a compliance? They took 10 of the standards of issued by the Institute of Chartered Accountants of India, made their slight adjustment which they wanted for the income tax purposes, and notified them to be made applicable. So that color which they have taken for ICDS V is for the old AS. So that is only for tangible fixed assets. Few examples I would say the difference which we will feel. For example, in the AS or the Ind AS, we say the asset is to be depreciated over the useful life. But in the ICDS V, they say it has to be depreciated as per the income tax, the WDV method, not over the useful life. Then the disclosures are totally different. Disclosures in the ICDS V is similar to clause 18 of the 3CD, form 3CD. In the AS and the Ind AS, we have to disclose all these gross block, depreciation block, net block, the method of depreciation, and all those we have to do. But there, ICT is not, that is not required. Many other differences, for example, revaluation. As we say, at the fair value, we have an option in the AS and the Ind AS, but ICDS there is no such option. If there is a disposal of an asset, then disposal of an asset in the books of the companies, or I would say in the AS and in the Ind AS, we have to de-recognize the whole asset and book the profit or loss depending upon its WDV value and the gross block which we do. But under the ICDS V, they say it will have to be as per the income tax. So it goes as per the block of asset system. The assets, maybe for example, an asset is there for 10 lakh rupees. The WDV of that as per books is say 5 lakh rupees. And that is sold for say 4 lakh rupees. So in the books of the companies, the 1 lakh rupees, there would be a loss on sale of asset. But under the ICDS, they say 4 lakh is the sale value. So you follow WDV. Whatever is your block of asset, you reduce that block by 4 lakh rupees. So that is a difference which has to be adjusted to the computation of income. So lots of differences. Another difference, if I talk about, is about the spare parts, major inspection costs. In the AS and the Ind AS, they say you have to recognize and de-recognize the cost of the replacement if it meets the criteria of the PP. So suppose that part is not used frequently, it is other than the small parts, and its life is more than 1 year, then you have to de-recognize the old part and recognize the new part. Whereas ICDS that talks about that old AS10 figure which says that any expenditure which increases the future benefits from the existing asset beyond its previously assessed standard of the performance, then it has to be added to the actual cost, otherwise. So yes, there are quite a bit of differences in the AS10 or Ind AS 16 in comparison to the ICDS V. So that everyone has to keep in mind. That is only for the purpose of income tax. But yeah, in the tax audit report, we have to take care of that for the computation and disclosure.
Thank you, Pramodji. Another important fundamental question, BL Sharma ji, it's for you. What is the criteria for classifying a tangible asset as PPE?
Yes. So when we talk about the PP, property, plant, and equipment, so we should know that which all assets and how to identify that this assets is which needs to be capitalized, this assets cannot be capitalized. So for that, standard says you need to evaluate the conditions given in the standard, and basis on the conditions, basis on this judgment, only you can capitalize that assets and you can identify as a PP. So if I talk about the main primary condition, two conditions that talks that standard says that you should evaluate first that the assets which you are evaluating is the future economic benefit associated to that asset will flow to the entity, and condition with and the cost of that item can be reliably measured. These are the main primary two conditions. And apart from these two conditions, that for the PP, further if I elaborate the PPE definition, then the standard also says that you need to check after evaluating these two conditions, whether the benefit associated to economic benefit associated to that assets is flown to the entity and cost associated are reliably measured, then you need to check as the assets are held used for the production or supply of that particular business, or are held for rental and other purposes, or for the administrative purpose of that particular business, or for the particular company. I'll come to the point on administrative purpose later on, and are expected to be used for more than one period. So these are four main condition when management should assess for assessing every asset to be capitalized. So now we have seen here one point that whether the assets are used for the administrative purposes are also to be capitalized, but which all assets? So many times when we enter into many business premises, we have seen many big paintings are out there, but these are not used for your to generate a cash flow or to generate for the supply, but are these assets are kept as for the administrative purposes, I would say, or any other which are kept for the administrative purposes. And also there are many few examples which I would like to highlight is around like paintings and paintings, and these and some important paintings of main painters painting with some signature. So here standard says management needs to evaluate whether these assets are for the capital appreciation later on. If suppose some antique items kept by the management, and are these items for the further capital appreciation or what purposes? So there also some management evaluation required around to identifying the tangible assets. And then so after evaluating all these four conditions and further management evaluation, we can identify this assets to be capitalized as PPE and this asset not to be capitalized as a part of the PPE.
Thank you, Bir Sharma ji.
Just like to
Yes,
add out here what Sharma ji has said. In fact, this becomes very, very important, whether that tangible asset would be PPE or it would be an investment property.
Yes.
So here, what happens that in many of the cases which we have seen, specifically in the case of immovable property, where there was a certain property which, and this is applicable for all entities, because many of our participants would not be based upon Ind AS, they would be based upon, say, proprietorship partnership or small company. So for all it is same. So whether it is a PPE or an investment property, how to determine that for an immovable property, that becomes very important. A simple example, if that immovable property has been held for the purpose of appreciation or for the purpose of rentals, you will see a lot of our clients are having immovable property which are earning rent and no other purpose. So that has to be not a PPE but investment property.
Yes.
So one has to be very careful in classification thereof. The duty of the auditor is there. Kindly see that it should be classified not as a PPE but investment property. And secondly, that investment property is further to be depreciated also. In income tax, that due to rental income, depreciation is not allowable. But as per the books, the depreciation is to be provided. So kindly take care of that. Adjustment would be made in the computation of income. But compliance is when we are doing the audit, we have to ensure that it is properly done as per the accounting standards.
Thank you, Pramod ji. My next question is for Raj Kumar ji. So for entities who are required to adopt Ind AS for the first time, like you had mentioned about the transition provisions when you were highlighting the difference between AS and Ind AS, what are the major challenges they face? And what all things should be kept in mind so that the transition is smooth for such entities? So you're on mute.
Thank you, Asta. So I think this conversion or transformation from the existing gap to a new gap is a very important, and it has a far-reaching impact on the entire history of the company, as well as your entire numbers, as well as presentation, disclosure, and your background practice. So when we see the theoretical write-ups about all the conversions, normally we see that you have to convert this, you have to convert that, and there is again a laundry list for all that. But let me share you my experience from all the conversion exercise which I had. So I would like to rather group all these challenges in 4 different type of challenges. Let me, I'll just repeat after my discussion what were the 4 and how do we do that. Let me address the first one, that is the mindset challenge. The moment a company or a management comes to know that you have to convert, then there is always, as you know, everybody right to resist the change. The first thing is that we have to have the mindset that yes, conversion is important and it has to be taken up, it is required, and accordingly it will be worked out. The mindset challenge also is required for the entire staff and all the service provider, where they have to understand that where we are coming from and where we are moving. The first fundamental challenge is that when we were on the cost convention and when we are moving to fair value, certainly the balance sheet would be at a fair valuation level and our profit and loss would be volatile. Each and everything, there would be volatility in either OCI or it will be P&L or somewhere else. So this mindset change is one of the most important part, and this I think is the first challenge as per my practical experience. The second challenge is about the implementation. That is the core what you actually read. Now the implementation of course required that you evaluate what would be the impact. It could be initial impact study and then the final conversion. But let me tell you the key points where the basic challenges are. The first basic challenges come at the point of choices. There are some choices given in the 101 where you have to say whether you want to adopt that or whether you want to take that choice or not. Say for example, in the PP you have a choice that the deemed cost either can be the cost of PP in the previous gap or it can be revalued. Now that is not an easy choice. It has lot of repercussion, it has lot of thought process around. So the first thing is the laundry list of choices that you make, what would be the impact and evaluating the impact. In the implementation, the second choice is the financial instrument. The financial instrument in itself, the accounting standard, they range over 3 standards and one of not less than 200 pages, and there are a lot of points here and there. So therefore, the at the time of implementation, the financial instrument conversion, their presentation, disclosure, as well as valuation and recognition, everything, that is where one of the most important challenges is. The third thing, friends, I like to tell you, there is one very easy accounting standard which is called deferred tax. Somehow, that is one of the items where even FRRB has given that there are a lot of problems and there are a lot of observations. And when on in conversion as well as in Ind AS, normally we miss the impact or maybe a miscalculation or maybe non-presentation or non-sufficient presentation of the deferred tax asset or liability. So therefore, one thing which I'll suggest to all of my professional colleagues is, it is once the concept is there in the mind, you'll evaluate each and every difference together with the tax difference in it. So every change, every conversion has a tax impact, and that tax impact has to be covered in our conversion as well. The another implementation issue is the business combination. Now, certainly in smaller companies, the business combination might not be triggered, but in and let me tell you, one of my friend who's a service provider in US, he was sharing with me that in US, every week there are at least 10s or 20s of the mergers and acquisitions. There the concept is not a greenfield. Everywhere, wherever we start, we think that we'll build the project from zero to this, zero to the largest of the company. So basically, merger and acquisition has taken the fancy or taken the ground in India as well. So therefore, business combination going forward would be important. But I think till that time, most of the conversion would have happened. But yes, as of now, business combination is one of the issues. Another, the implementation challenge comes in the revenue. Now, for a reasonable good company, whenever we are implementing Ind AS, certainly you have to look for each and every of the agreement. You have to see what is the revenue. And I'm not going inside that because today we are dealing with PPE. So therefore, there could be a lot of changes in the revenue. There could be changes in the timing of revenue. Of course, disclosure and presentation would be there. Implementation also has issue and challenge in the consolidation. So again, it has its own, what would be the subsidy, where you control, where you don't control, who would be the RPT. So those are the items. One very practical thing, and this is my thought and suggestion to our chairman also, in respect of the model which are related to the provisioning on debtor, which we call it ECL, expected credit loss. Now, certainly we have to build our expected credit loss model and accordingly provide the expected credit loss. There are a lot of said about the model, but at least some fundamental 2-3 type of model or 2-3 type of iteration, I think it can be suggested at a good level. So I think each and everyone can at least benchmark with the basic ECL model, and I think most of the time is invested in working and implementing of the ECL model. Last but not the least, one of the challenges is with the fair valuation. So even if the valuation would have been the same as normally, but when we go for 113, there are a lot of exercise that is to be done. So yes, these are the implementation challenges. As far as the impact, there is another challenge which is I called as impact challenge. Whenever there is an impact challenge, you have to actually, before that, you have to take cognizance of the fact that it could have impact on your borrowings from financial institution. It can have impact on your profit. It can have impact on your tax. So all these 3 items would be there. And one of the most important impact is probably in family business, whatever the secrets or not secret, I would tell it, what many of the things which were not disclosed would now be disclosed. So that is the impact challenge. The last is the cost challenge. Everybody has to understand that the conversion in itself has to be done seriously. It has all future impact. And also one has to understand that any correction is not a correction, it is restatement of the account in future. So that is an important aspect. So therefore, the conversion entails not only the conversion cost, but also future accounting cost, the training cost, and the change in accounting system as well as the MIS system. So these are the cost challenges which one should also accept. So if I sum it all, there are basically 4 types of challenges. First, let us change our mindset. The second is the implementation challenges, which are related to the different type of accounting standard or Ind AS. The third is impact challenge, what impact challenge it would have. Then the cost MIS accounting system. As far as, since we are dealing with PPE today, so therefore, the important challenge as far as PPE is concerned is the choice of cost model or the revaluation model. And just one simple thought, to overcome this challenge, one important factor is time. Start early and start doing things. It actually takes time for a real conversion from one balance sheet to some other balance sheet. That is all I would like to say.
Thank you for sharing your insights from your practical experience. And you very rightly said that, timing is of essence when it comes to, convert from the previous regime to the new Ind AS. Thank you for your insights. I remember, Rajkumarji, when you were giving us the evolution of the accounting standard, you had given a passing reference to CARO as well. So this clause 1 of the paragraph 3 of CARO 2020 deals with the important matters related to PPE, and which forms a part of the audit report of certain classes of companies. So can you please enlighten us on the same provision?
Yeah. I think most of our friends would have attended or at least read CARO 2020. So, and this is very important. And the very fact that the first clause of CARO is with regards to PPE. So, friends, just give me your attention for 5 more minutes and let us learn what does the CARO requires us for PP and what we have to do and how it has to be done and what are the major changes. I would more concentrate not on the audit aspect, but what is the major change aspect. And it is a rightful question at the right moment of time because most of the companies would now have been audited. Thank you for that. So, friends, with relate to PP, there are 5 clauses, sub-clauses in the first clause of the CARO 2020. The first is about the maintenance of particulars. Second is about physical verification. The third is about having the title deed. The fourth is about the revaluation. And fifth is about the Benabi property. So whenever you are doing audit or whenever you are dealing with PP, remember all these 5 items. Now let me take you. So I like to limit my discussion. So what are the changes? I'll concentrate on that. So the A part. Earlier, as I told that the word that were used in CARO was FA. Now it has been changed to PPE. So therefore, clause A, whether the company is maintaining full particulars of the asset is showing including the location and numbers, etc., etc. So now it is whether the company is maintaining all particulars of PPE, etc., etc. So that is the first thing. But together with the change, there is another clause added to it, which was very, very important, which is about the intangible. So when I used to say whether the particulars of the fixed asset are maintained, nobody actually ever paid attention to the intangible asset, whether the particulars are maintained or not maintained. So another clause which is added, whether all particulars, all details with regards to intangible asset are added or whether they are the particulars are maintained or not. So that is the first thing. So friends, whenever you go for an audit, if you find intangible asset, first call for the details of intangible asset. It might be possible that the company would not have been maintaining these details and they would be required to maintain these details from this year. So therefore, try to emphasize on the fact that you take all the particulars of intangible assets. Now, I'll not go into the detail what could be intangible asset, how those particulars to be maintained. I leave it up to you. Now, clause 2. Clause 2 is whether the physical asset whether the fixed asset have been physically verified by the management, etc., etc. Now, in that word, physical as fixed asset has been deleted, and the word PP is been added. So that is clause B. Now, the third clause is with regards to the title of immobile property. This clause was earlier also there, and it told that whether the title deeds of the property which are listed in the financial statement are in the name of the company, and if they are in the name of the company, whether title deed are maintained, and if it is not maintained or not in the name of the company's name, or I mean to say, if the title deeds are not there or the name of the company is not there on the title deed, it is in name of somebody else, you have to give the details thereof. Now, together with that, the nomenclature of the detail has been also added and clarified. That is, you have to give the description of the property, which is not in the name of the company. You have to give the gross amount, carrying amount. gross carrying amount. So it gives the impact whether and how depthful that particular item is. Then you have to also tell in whose name it is. Now it could be in relative's name, or it could be in third party name. Now that I find very interesting. That in whose name it is. And equally interesting is from what time it is not in the name of the company. Now say suppose if you have taken up a property which is only 1 or 2 years, then it can be under. But if it is for coming out for last 50 years, so the question is, what is the management doing for last 50 years? So how long it has been there? And together with that, if it is in name of somebody else, whether that is a related party or not, or promoters or not. I would say there's the specific word promoters or not. So if it is in the name of promoter, maybe that property has been contributed as a capital initially. So it could be in the name of promoter as well. And last but not the least, what is the reason of not holding the property in the name of the company? So I think if I read all these, the management would say it is better that I get the property changed in the name of the company, whether it entails the stamp duty or maybe other formality that is to be done. So that was about clause 3 or clause C in this particular PPE item. There are 2 more clauses which are newly added. The first one is, now as we know that one of the model in PPE, subsequent measurement, it is whether you can adopt the cost model or the revaluation model. There could be another reason for revaluation as well. So therefore, you have to disclose whether a property, plant and equipment has been revalued during the year. So if PP is revalued during the year, you have to then give and answer 3 of the questions. These questions are, is it revalued? Is the revaluation done by a registered valuer? And if yes, or even if no, whatever the case may be, the third part of the question is, if there is a change in 10% of the valuation for each class of plant and machinery, PPE, then you have to give the particulars for each of them. So 10% each class would mean that if for building, if there is a difference of 10%, you have to disclose. So this is the part D. Now another clause which has been incorporated, which is actually part of the amendments and notification, is about the Benami property. Now as per the notification, we have to disclose the Benami property in the financial statement itself. So the reference to the financial statement and the audit report should be completed. So that is covered under CARO. For Benami property, we have to give the fact whether the details are disclosed or not. So it is not only on management to disclose the details, but it is also on auditor to confirm whether there are Benami properties or not. If they are, then the details are disclosed. So these are the 5 items for CARO, which we have to remember. Just to recap, I repeat it. 1, physical verification, no changes. Maintaining particulars, no changes, but particular of intangible is to be maintained. Physical verification, no change. Title of properties, basically no change, but further details. Then revaluation, newly added, where you have to give the 10% or registered valuer, whether it is with registered valuer, and last, Benami property, whether the details. So these are the changes which are coming out or emanating from the recent changes in CARO, and they are most important for our fellow friends for the audit purpose. That's all.
Thank you, Rajkumarji, for giving us subclause by subclause information on the CARO. It is very useful, especially at this point of time, as you rightly said.
Yes.
Moving on to the next question. B.L. Sharmaji, for an entity who's at the stage of setting up its office or manufacturing facility and is it yet to commence its operations as on the balance sheet date, how should the management apply Ind AS 16 in such a scenario?
Yes. So to answer this question, as you mentioned that company is yet to commence the operation, and the setting of the plant and machinery is already taken in place. So I'll take into the two scenario. One is that if when first I jump into the standard says that you stop your capitalization, you cease your capitalization, capitalizing assets at
Dear Sharmaji, you can maybe switch off your video because there's some network issue. Yeah.
Sorry, is this fine?
Yeah, but
yeah. So standard says that you need to cease your capitalization at the moment when the assets are at the location and is in the condition which is in the manner of intended use by the management. So you need to stop your capitalization at that moment. So if I talk about this question, then in this question it is mentioned that a company have already company is in the stage of setting up the plant, and the 31st year end came up. Then it means company need to evaluate, the management need to evaluate whether the intent the machineries and plant are in the condition in which management want to use. Is it in the intended condition which management have pre-decided to bring that machinery? Now, if I further reiterate this conditions, so management there are few situations where management have decided that I will only capitalize when the desired trial run have completed. Desired output will if they can see the desired output, then only they will capitalize. Then this at the year end, this machinery will not be capitalized because output the desired trial run have not taken place. If I assume trial run have not taken place, then this machinery still will be in the CWIP condition only and not to be kept.
Dear Sharmaji, we can't hear you. Am I audible? Okay.
Intended use or not in that at the location where management want to produce the goods or not, then only they can capitalize the machinery.
Okay, thank you, B.L. Sharmaji. Rajkumarji, the next question is for you. In a capital-intensive industry, there is a constant challenge in recognizing spare parts, standby equipment, and servicing equipment as PPE. So, what all things should be kept in mind while classifying such tangible assets as PPE? Sir, you're on mute.
Thank you, Asta. I think whenever a PPE standard is discussed, the problem of standby equipment, spares, and all these, they are very integral parts. So let me give a sincere attempt to clarify your doubt and let us relearn it. That is how I would say it. So first is spare parts. Spare parts are basically, as you would understand, which are part of the machine, which may be changed or which may be used for running the machine. With regards to standby equipment, let us take an example of airplane. As you would know, there are two engines in the airplane. One is always on the running, and the second is always on the standby. It may not be used, but it is always on the standby. Then next is the servicing equipment. Like say, for example, in case of car, you may have some maybe brush or something like that for servicing, or maybe some specialized thing. So there are a lot of plant and machinery where there are specific servicing equipment which are associated with the same thing. Okay. So this is how we understand what are spare part, standby equipment and service equipment. Now let us understand what is the principle of recognition under PPE. The principle of recognition under PPE is first the definition that PPE is used for the purpose of production or for services. Now any items which is used for production or services can be part of PP. That is the first fundamental. And the second part of the requirement of the standard says that it is used for more than one period. May not be a year, but it is for more than one period. So anything which is used for purpose of manufacturing or production or for services, and if it is used for more than one period, it is basically a part of PP. Now for recognizing an item as a PP, the principle further elaborate and that we can say is that if future economic benefit can be derived and the cost can be reliably measured, then you can recognize, right? So basically these are the 4 touch points in the principle where you decide. Now let us apply these all 4 principles on these 3 items: spare part, standby and servicing. Now before we apply this, what are the possible treatments? If there is a standby equipment or there is a service equipment or a spare part, what you would do? The only other possibilities which I see is that it becomes part of inventory, right? So either an item can be a part of inventory or it can be a part of PP. Now before this, let me also clarify one of the very on-ground practical problems. Whenever a spare part or standby equipment or service equipment are purchased, there is a concept called stores and spares under the inventory. Please understand that is a different concept and this is a different concept. Those are the items which are purchased early so that you don't have to run each and every time for purchase of a small spare part or maybe a small item of plant and machinery, and the acquisition cost would be more than the cost of the item itself. So anything which is parked as a stores and spares, they would be used in the future and they are normally the part of inventory. So let us not be confused from them. Now, our problem starts at the point when an item is issued from a stores to the ground or to the shop floor level or to the administrative building. How do we deal with it? So let me tell friends that all the spare parts, all these items, normally they would be part of PP if they meet the definition of PP. That means they'll be used for more than 1 year. They are used for the purpose of production and their future economic benefit would flow. So normally if they are used for production, which normally would be there, so in most of the cases the position would be there that they would be the part of PP itself. If still it is not meeting the definition, that then you can transfer it into the inventory. From a practical aspect point of view, we have to also understand what will be the difference to a owner or to the management if an item is parked in PP or inventory. If it is in inventory, the moment you consume, you'll write it off or it will go to the profit and loss account. If it is part of PP, only the depreciation may be 10%, 12%, whatever the rate may be, that would be the part and it will flow over for 4 years. Now that is how you'll actually analyze that whether it is used for production and if it is for more than one period. So therefore, if it is being used over a period of time, then certainly, and for the production, then it will be a part of PP. Otherwise, you can take it to the inventory, write it off, get it. Now, in this aspect, there is also another thing which is called molds, dies, etc. In entire OEM industry, the molds and dies, they are one of the most important part and they are one of the major cost. So what are mold and dies? Say for example, you have a brush toothbrush, say, simple example, you have, or a pen. So what happens is there is a mold in which the plastic is injected by an injection molding machine. And in that mold, that plastic gets hardened and you get the desired shape. And again, that shape or the pen or the brush is removed. And again, another time the plastic is filled and you have that production. After a certain production level, that particular mold or dies, they are not used, and or maybe the item is changed or maybe the model is changed. So normally this mold, dies and other items of this nature, they are individually very insignificant, but they are combined as a whole. And then they are depreciated over a period of time over their useful life. And the life of dies and molds can be easily it can be ascertained because there is a technicality associated with it. So you have to go into that detail and depreciate it over a period of time. Friends, you have to also understand one important thing, that the accounting standard does not prescribe the what you can call it as a unit of measurement. By unit of measurement, we want to say is, let's say, suppose if you bring certain things, there is no system which calls it that it is a plant or it is a machinery or it is a vehicle. It is not prescribed under. So unit of measurement is not. And here, that is what the most important part. In AS, there is one interesting aspect which is captured, and it is not captured in Ind AS, is though fundamentally it would be there, but basically it is specifically captured. Like say, for example, in a project, when a greenfield project is established, you would have first the building going on and plant and machinery items coming, and there would be some civil work for installing the plant and machinery. Then there will be hell lot of items and blah, blah. And then finally, you have list of all the items. Now you have to combine them and find and block out the plant and machinery. So a very interesting aspect is also given in the AS, that if it is a project, certainly it can also be capitalized as a project itself. But together with that, you have to certainly itemize in different things. And together with that, at the same point, you have to also remember the component principles. So in the component principle, accordingly, it has to be worked out. So just without deviating, coming back to the spare parts and all this thing, for the purpose of depreciation of a spare part, it will be decided from when it is available to use. And as and when it is available to use, the depreciation would start. Say, suppose any of the spare part is for less than 1 year, you can depreciate it in that year itself. So it may not need a capitalization. Another last point with regards, which is relevant for this is, which is also captured in AS 10 is, any item of plant and machinery which may not have a material cost can also be written off in that particular year. So say, suppose an individual spare part, though they can be combined, but even after combination, if the cost is not material, you can write it off. If it is used less than 1 year, you can write it off. Subjected to all this thing, if they are used for future, they will give future benefit and used for production more than 1 year, they are P. I think this should clarify. Even if any of my friend have doubt, maybe we can discuss it in question and answers.
Thank you, Rajkumarji, for answering this question with so many practical examples. Next question is for DL Sharmaji. Let's consider a situation wherein an entity is relocating its manufacturing facility from its current location to a new place. So in such a scenario, what all costs can be capitalized as PPE in relation to relocation?
Yes. So in this scenario, first we need to understand which all cost component are to be capitalized. When we capitalizing the property, plant and equity equipments, which all costs are to be part of my PPE. Okay, so I'll categorize all these all the cost into three categories. First is related to purchase cost. So first, under the purchase cost, if I'll talk about the purchase cost, then purchase price of that particular equipment which are machinery which we are buying, and import duties, and any non-refundable taxes, and and we need to reduce with the trade discounts which we are getting, and any rebates from that. And second part would be, say if I categorize into the second part of that is directly attributable cost. So which all directly attributable costs are the cost of employees which are directly associated to the construction of that particular PPE, and cost of site preparation. So cost of site preparation to bring that property into a operable condition as decided by the management, and I would say in intended use of the management. So, and then initial delivery and handling cost, I would add like transportation cost, etc., and transportation and handling, etc., and installation assembly cost, because that machinery and component which are that we are buying, or so we need to install also at that particular place. And then testing cost also, that whether that machinery is as per the desired product, producing desired product or not. And then other professional fees to test that machinery till the point as we discussed in previous question, that as per the intended use or not. And then which all other and few other costs also we capitalize regarding estimates of the dismantling cost, so future dismantling cost, and estimates of the site restoration cost, and major inspection and overhauling cost, as Raj sir already taken this that which are future estimates which we dismantling related to inspections or site restoration and all costs. So these all are the cost are part of the these all are the costs which are associated with the PPE to bring that PPE into a intended use by the management and in that particular condition. Now, to answer this your question, but there are few other costs also many times companies incur. So which all costs are like management are started production started, but they launch a new product and they incurred cost for to launch a new product. So standard says all these are not adding anything into that because machinery is already in that condition, that production condition as per the intended use of the management. Now if you launching anything, you are not changing that particular machinery, you are just modifying that machinery, but the production is still continuing in the same manner as you decided, that you already completed and you stopped the capitalization at that moment. So standard says this relocation also is not a new addition to your machinery in your because it's not changing your management intention of that production. Production is still the same, which you have already at the same place. Now you just relocating this machinery. So relocation are not an addition to that. So you cannot capitalize that relocation cost, and it will be charged to the P&L as it is.
Yeah, Astha, I'd like to add to what.
Sure, sir.
I think DL Sharma ji has very nicely brought out that you are not adding anything whenever a machinery is transferred from one place or relocated. Friends, in this, I would also like to tell you that even under the income tax, there is a decided cases that the relocation costs are not deductible under 37(1) or they cannot be capitalized. So I think under some explanation and 37(1), both are also. So either way, it does not find its place. But for business purpose, if you have to relocate, then you have to relocate. There is no other.
Thank you, Rajkumarji. As you had said that B.L. Sharma-ji has very answered this question quite professionally. Rajkumarji, the next question is for you. What is the derecognition concept in the AS and Ind AS?
Yeah. Thanks, Astha, once again. Friends, I think from the accounting standard point of view and from audit point of view, this derecognition and retirement of PP item is very important and often an ignored area. Once the PP schedule is there, depreciation goes and goes and goes on till it is finally it has come to zero. And even after zero, whether it is removed from the fixed asset register, not removed. So the first thing, ideally, what you should do to really make to really understand this particular part of PP is, before you start the audit, please go around and visit the location and the plant, and you'll find a lot of plant and machinery item lying here and there, and those are the items which are either retired or they are derecognited. They should be derecognited. So that is from the audit point of view. Coming from the AS point of view, let me pronounce these two words, retirement and derecognize. Retirement means a person is there, but he is told that he will not be working. Okay, I think that finds a good definition. And derecognition, that I don't know you, some sort of. That means we are not, that machinery is not at all useful for us, and that's all. It's end of it. That is what you call derecognition. As far as the accounting treatment is there, see, at the point of retirement, that means that particular plant or machinery or item of PP will not be actively used in the production process, is what you call retirement. So we take out one item and make it, say for example, if you have two cars, if you have brought new car and the older one was actually weak, so what you do is you use it for parking space, like we do in Delhi. We use the old retired car for just taking out or maybe reserving our parking place. So that may be its use, but in a normal parlance, ideally the retired PP is actually retired from active use, and it is basically held for disposal. The principle is very clear. The amount that it should find its place in the financial statement is the realizable. So it can be cost or realizable value or net realizable value per se, whichever is lower. And if we're from an Ind AS point of view, if we say, then it would be your carrying value, or it is lower of carrying value, or fair value less cost of disposal. So either way, net realizable value is fair value, broadly realizable value net of sales cost. So therefore, that is the point. The only more thing which we have to understand is, after retirement, there is no further depreciation. And at the time of sale or anything, any loss and profit goes to the profit and loss account. And that is the end of PP. The similar process also goes in derecognition. Basically, a asset is derecognized, means thrown out, said that we will not be using it, either when it is disposed of, when it was in use, you derecognize means you have disposed it off, or when there is no future economic value that is expected, so you derecognize. That is what actually it means. So in either case, the concept is very clear that it should not be carried more than its net realizable value or recoverable.
Thank you, Rajkumarji. I would like to apologize. My video camera is facing some technical issues, so I'll be available only in the audio format. I'm really sorry. My next question is for BL Sharma-ji. How does Ind AS 16 and AS 10 deal with a scenario wherein an asset is acquired by selling its existing asset? That is, swap of assets for non-monetary consideration.
Yes. So in practical also, many times we have seen this scenario that companies are exchanging their assets, or like sometimes they are giving the land, or giving the flats more in the real estate industry, as well as in the manufacturing industry as well, like warehousing arrangement and all. So what happened, friends, that sometimes we give one assets, along with that asset we are giving some monetary item as well along with that monetary item. So standards and the question is how to recognize the assets which we are buying, in exchange of that asset, or I would say swapping that assets with my current assets with the new assets, and along with if I give suppose if I giving some monetary consideration as well. So there are the guidance in the standard with guidance regarding the non-monetary consideration, and an arrangement of monetary and non-monetary consideration. So in that scenario, the cost of such items of property, plant and equipment is measured at a fair value. So at a fair value, but along with that, we need to see the scenario where the exchange of transaction is lack of commercial substance, or in that case, or the fair value of both the assets are not reliably measured. Both the assets which we are giving up and the assets which we have received are not reliably measured. In that scenario, standard says that you need to value the cost. Cost is measured at the carrying value of assets giving. The cost we record in our books only the same as the carrying value we were earlier in our books, because we are not able to reliably measure the fair value of assets giving up and assets we are receiving. So in that scenario, we record asset at the carrying value which we are giving up. Now the question is how we evaluate the commercial substance, because standard said you need to evaluate whether exchange transaction has a lack of commercial substance or not. Is there a commercial substance or not? Then again the standard given the guidance regarding that when we exchange our assets, then you need to evaluate the resulting transaction. Is there any change of configuration of risk cash flow associated with the receiving asset differ from the configuration of cash flow assets transferred, or is there any change in the operating cash flows of the entity? Okay, so in operation, let's take example. If I am receiving new assets and let's take example, X and Y swap their warehouses, and warehouses they are swapping their warehouses because they were at a different location but near to their factories. So one scenario is that factories are at a different locations. Okay, and by swapping warehouses, there would be addition of saving of major transport cost, saving of the any cold storage cost and etc. because of the environmental friendly to company X product, that particular warehouse. So by evaluating that, we need to see is that the cash flow which we are saving by transferring that cash flow or any other operating benefits which we are getting through swapping is more than the fair value of the assets which we are getting. Then there is a commercial substance and we value the assets at a fair value. If that is not the case, if there is no lack of the commercial substance and the fair value is not reliably measurable of assets giving up and assets receiving, then we value the asset at a carrying value which we are the assets giving up.
Okay. Thank you, B.L. Sharma-ji. B.L. Sharma-ji, sorry, yes, Rajkumar-ji, please add.
Sorry for interruption. I'd like to add something. Okay. So, sure. Yes, I think BL has brought out very nicely the commercial substance point of view. I'll give you a very small example of understanding what this commercial substance would be. Say, suppose you have an iPhone, which is fair valued at, say, 13,000. And your colleague has a OnePlus, that is one of the best models. That is fair valued at 13,500. Okay. Now you want to exchange your iPhone with the OnePlus model. Now, if you have to evaluate what does this commercial substance would be. Now, there could be two reasons why you want to do it. The first reason could be that you want to access certain apps which are not there on iTunes or iPhone apps or App Store. So if that is the reason, that you can call it as a commercial reason or commercial substance. If say suppose you want to exchange the phone because you are bored by iPhone and you want OnePlus T because all your other friends have OnePlus T, that is non-commercial substance. So therefore, in case of exchanges, this commercial substance actually brings us to the fair value. That means wherever the commercial substance is there, you have to look at the fair value also. Otherwise, it could be the value which you were carrying in your balance sheet. Like say, for example, if you give your phone without any reason, take another phone, your cost would be same as what you were carrying, whatever may be the fair. That is what it is.
Thank you, Rajkumarji, for giving us such a wonderful example. B.L. Sharmaji, moving on further, I have this question relating to component accounting. Can you introduce us to component accounting? And also, we would like to know what was the criteria of introducing it for Indian entities via AS 16. Ind AS 16.
Yes. So if we talk about the component accounting, identification of component accounting. So as Rajkumarji mentioned in their earlier question as well regarding molds and detailed explanation in that. So I would like to add in that aspect this component. I want to add this also in that same scenario, the component component accounting. So the component accounting is the main post Ind AS and post Ind AS and the AS 10 which modified. Then earlier there was no such identification, but post Ind AS and after modification of AS 10, component accounting is the major change, I would say, in the PPE accounting. So what has happened that we need to evaluate each and every item. When we capitalizing an asset, we need to evaluate the items, or we need to evaluate the components of that PPE, whether this have a significant cost, whether have a different useful life or not. So and many other aspects as well, as decided by the management in term of the replacement of that particular item, replacement life, or in term of cost to be incurred while replacing that item, and the benefits flow to the entity. So we need to evaluate all these aspects, but major aspect, if we talk about the identifying the component in particular PPE capitalization, that is the significant cost associated to that item and the differently useful life. That two parameters we need to assess, and basis on that we need to identify that particular component is to be capitalized separately. Now if I give the example on this, then let's take an example of a very famous example related to the capitalization of the charter plane. So in that case scenario, there are different situation in the charter plane or in the ship. Like in that ship, the main engine is a separate, and in that engine there are many interior cost as well. Then there is a cost of major overhaul inspection and navigation system. There is a separate navigation system also there, and fit out assets also there. So standard says that even the life of the engine is the separate, and the life of the fit outs is the separate, navigation is the separate, and the cost associated with the significant, because these items also having a significant cost. So you need to evaluate that. And also one example related to building. Under the building structure designing, we have a separate component. Let's take example of any society. Under this society, we have separate components like staircase, like elevators, like air conditioner, like heating systems, like water systems. So all these items are having a separate useful life and having a significant significant cost associated to that. So standard says if you are able to identify that, then you need to capitalize separately all these items and depreciate according to their according to their useful life, that particular component.
Thank you, B.L. Sharma ji. Rajkumar ji, revaluation of a property, plant and equipment is quite a tricky area. What does the AS 10 on Ind AS 16 has to say about it? Sir, you're on mute.
Thank you for always reminding.
No problem.
Yeah. So, friends, I think this revaluation is one of the items which has been always a problem, and will, I tell you, it will remain a problem, more of a problem every time till we do the accounting in near future at least. The reason being, one, it has a fair value concept in it, and second is the accounting entry, and accordingly, it's a lot of things to decide. So let me make another attempt to make it easy for you to understand how do we deal with revaluation. So I'll give you 3 points where you can understand it in a very simpler way. The first is the concept. So revaluation, as you know, the Ind AS 16 as well as AS 10 gives us two models. One is the cost model, which we have been following over a period of time, and another is the revaluation model. So therefore, the basic concept is that we can value or revalue, I mean to say, we can revalue the assets or a class of asset based on the accounting standard and use it as the carrying value after depreciating and impairment cost. This is the first basic principle and where it is arising from. So therefore, say suppose a company decide that if I brought a plant and machinery for 100, so I would not depreciate it 10 over 10 period of life. After 2 years or 3 years, I would revalue it and then again depreciate it. I'll revalue it and then so that is one of the acceptability by the AS. In one of my recent examples of professional life, one of my one of the company where I gave some services, they had used it very nicely and to reflect what actually it should be reflected. They were running a fleet of car. Now, car or taxis. So in taxis, what happens is some taxis get weared out very hard and some taxis, so all taxis would not have a life of 7 years or 10 years. Some would depreciate over 5 years. So what they decided is that after every 2 years, we'll revalue all our fleet and it will give us approximately what will be the market value and it will be the fair value in the balance sheet, so that we can actually absorb and evaluate the actual profit and loss made. Otherwise, what happens is after 4 years, we are again at loss when a particular group of car gets disposed of or derecognized. So the first concept is about the revaluation. Concept is that you can revalue. Now, when you are revaluing, you have to revalue it with sufficient irregularity. So suppose it does not mean that once you have taken a revaluation model, once you revalue and forget it. It is not that concept. The concept is basically you, instead of having the asset at the written down value, what you do is you revalue it and then depreciate it after that. And once if you revalue after 2 years, if its value goes down, then again you have to revalue whether its value is going down or it's going up. So both the ways it has to be reflected. It is not one of the ways. Therefore, it is given that it has to be substantially, it has to be with good regularity. Then one more, another part is the actual valuation. So the valuation basically, when we do the valuation, you cannot do it selective revaluation. So selective revaluation is not allowed under either of the standards. But you can have rolling revaluation. Rolling means in a year you can do different types of plant and machinery at different times of the year. That is what the concept. And last, the entries. Once the revaluation is there, either the value would be positive or negative. If the value has to be positive, there is a different concept of accounting entry. If it is negative, there is a different concept of accounting entry. Due to paucity of time, I'll not go into the how you do the entry, but I'll give you a concept in brief. Say suppose when you do a revaluation, there is 100 rupees plus value what we have. It will impact two sides. One is the asset side and the other side is to be impacted. In the asset side, the net value of the asset has to be increased. That you may adjust either in the gross and the depreciation or can be adjusted against the depreciation. And the second part will go to the revaluation. That is what the fundamental is. So you have to see again and again how this valuation would be done in this small period of time. It would be difficult to touch upon the accounting entries, but to recap again, the concept is you can revalue the asset and use it for further depreciation, and accordingly you have to do it with sufficient regularity. The valuation cannot be on a selective basis, and as far as the accounting entries are done, both the side has to be looked into and accordingly adjusted. In Ind AS, this particular revaluation goes through OCI to revaluation reserve, and in a normal account, it goes to the revaluation reserve. That is broadly the difference. Over to you, Asta.
Thank you, Rajkumarji. BL Sharma, the next question is for you. What are the financial reporting requirements related to PPE in Schedule 2 and Schedule 3 to the Companies Act 2013? I would request you to include the recent changes in Schedule 3 relating to PPE financial reporting.
Yes, sure. So, friends, so we have seen there are many changes under the guidance note for PPE. Regarding, let's take example of one major change is regarding CWIP, that we need to give the aging of the CWIP or under construction properties. We need to give the details of the aging as well. So there are many changes. We'll touch upon that as well. So before that, if I would say the main disclosure requirements related to PPE is related to classification. So guidance note says, Ind AS regarding Schedule 3 guidance note says we need to classify all the categories related to the PPE, like land, building, plant and equipments, and furniture and fixtures, and vehicles and office equipments, bearer plants, and others. But if you cannot show the others, you need to specify the actual asset is, which actual assets is. So apart from the classification, we need to show all the gross block reconciliation regarding whether any addition, deletion in that gross block, and if there is acquisition through assets are acquired through the so that reconciliation is from the beginning to closing balance, beginning to end, and that gross block reconciliation of each class assets wise. So assets each class wise, each assets class wise, I would say. So under this, like if there is any addition, disposal during the year, acquisition through business combinations, or amount of change in due to revaluation, that is a new change. So due to new change, that revaluation, we need to give the disclosure if the change is more than 10% of aggregate of the net carrying value of each class of assets, as Rajkumar sir mentioned earlier also this in detail, and other adjustments related to like impairment and depreciation and reversal of that disclosure separately we need to give. Along with this, we need to give the comparative informations as well related to these assets. So apart from these reconciliations, if there is apart from this reconciliation, reconciliation of the gross block, we need to give the reconciliation. We need to give the reconciliation of we need to give the reconciliation of depreciation as well. That how much the depreciation at the beginning and how much the amortization during the year. Is there any total accumulated depreciation at the beginning and during the year charge of the depreciation and the closing balance, and then we need to give the net block details about this. And if I talk about these all are the disclosures, and apart from this disclosure there are many other disclosures as well, like if we are converging into the new Ind AS, then we need to give the deemed cost disclosure as well, and we need to give the PPE entire disclosure, and the business in the case of the business combination we need to give the entire PPE disclosure as well. So these all are the considering constraint of the time, I'm not touching all these disclosures but related to that. But if I talk about the changes, then in the major amendment is just related to CWIP. So earlier we were not showing any such disclosure regarding the reconciliation of means aging of the CWIP, project wise aging or project progress report, like whether sale be given in the period of less than 1 year or less than 1 to 2 year and 2 to 3 year. So we need to give all these more than 3 year, we need to give this into the financial statement related to CWIP, and that should be tallied with our CWIP amount which is shown in the balance sheet, that aging which we are giving. And apart from this, we need to give the detail of the project activity has been suspended or shall be given the separately. If suppose some project activities which are under the suspension or something, so we need to give the detail separately for this. And then as sir mentioned while answering that CARO reporting, in line of the CARO reporting there is a change in regarding the immovable property not held in the name of the company. So that requirement also, there is no such requirement and disclosure requirement. There was no such requirement under the Schedule 3 earlier, but after post amendment, companies needs to give this all immovable property other than where the company arrangement with and not in the name of the company, but company is using the title deed are not in the name of the company. However, the company is using that assets or the assets which are jointly held in the held with the others. So companies need to give the description of the property, gross carrying amount of that particular property, title deed held in the name of the property, whether title deed holder is promoter or director. So we need to give all these details. And since when this information is very important also, that since when the company which date the company is using this property in the for their production, even the property is held by property title is at the some people other name, or or I would say in the relative name or in the promoter name. So these all information for the more transparency in the changes are in the Schedule 3, so that companies can give the information. And as we touched on the revaluation detail also, so that if more than the 10% amended requirement is if there is a change in the 10% or more in aggregate of the net carrying value, then we need to give the disclosure of each net carrying value of each class of property while revaluating. So we need to give the details of that as well. And last but not the least is Benami property details, though that is also an amendment. So this information also we need to give now onwards in the in financial statements as per the Schedule 3 requirement. The detail of all the Benami property details and amount thereof, and detail of the beneficiaries if the property is not in the book. So this is the main task for the auditors as well, because this will be requiring in the CARO as well. So all these information now onwards we need to give in the financial statement as well. Yes, over to you, Astaji.
Thank you, B.L. Sharma ji, for summarizing the disclosures related to financial reporting. Rajkumar ji, my next question is for you. How is the impairment to be assessed and recognized for PPE?
Yeah. I think again a very important item. Impairment is one of the items which has been missing. So let me summarize in very brief. Friends, you have to understand that when we are moving to a fair value concept in the balance sheet, so the concept is the amount of any asset which we are carrying in balance sheet should not be more than, or it should be the recoverable amount of that asset. The basic thing. That means if you are telling a particular asset is X amount, then that should be its recoverable. Now, the concept is that for the purpose of PP, different assets have different accounting standard to see that they are stated at the recoverable value. Say financial instrument, or maybe inventory, it is cost or fair market, whatever. So every item has the basis. For PP, the fundamental is impairment. Friends, let us consider let us hear out the principle of impairment. Basically, a impairment is not when a small machine item is stopped or it is torn out. Basically, impairment is if our future value, see, we acquire asset for use in future, so that value would be recovered either from the future use or from its resale. So the impairment actually occurs that if we are not able to recover the value which we are stating in the balance sheet by the future use of those assets. If we cannot recover it in future, the better way is we account for it in present. This is basically what you call impairment. Impairment basically is not, it is triggered by some of the factors which could be internal or external. Again, I'm not going in detail, but the fundamental of impairment, if I say the formula is, impairment is when the carrying value is more than the recoverable value. And how do you calculate recoverable value? How much amount I'll be able to recover from a PP? It is either through value in use or through sale. So value in use is the future value, or rather the present value of the future cash flow is the value in use, or it is fair value less cost per disposal. These are the items which are decided. Out of that, you will take higher one, because if an asset can be sold, then you'll take that particular value. So higher of those, both the value in use is taken. This is what you call recoverable value. And if the carrying value is more than the recoverable value, that difference or that iota is what you can call as impairment. You have to impair an asset, then you have to put the amount, reduce it from PP, take it into the profit and loss.
Thank you, Rajkumarji. B.S. Sharmaji, how does Ind AS 16 deal with the scenario of leasehold improvements made by the lessee?
Yes. So we have seen many situations around us in our corporates or all the business premises which we visit. So there are the main business premises are on the lease. So and that business premises which we are taking on the lease are either vacant offices, or are not as per the are not according to architect structure of the what management want. They want 3 cabin, 4 cabin, 5 cabin, or 1 cafeteria, or around the sitting area for the for their team, and different sitting areas, and etc. So what management do? So management improve that skeleton properties, or that property which they have taken on the lease, and then they do some development on that, and then they make the like new cabins. They made some offices in that area, new cabins in that area, cafeteria in that area. So what standard says that when you are that property which you have taken on the lease is already covered under the Ind AS 116 and are to be recorded as according to and deal by the Ind AS 116, and you record as a ROU assets. So that is altogether a separate topic, and I'm not going into that detail. But the property, once you taken on the lease, and now you are improving that property according to your desire, according to your intention, according to the management intention to use for the business purpose. So that is that improvement, that is that new construction on that lease property is called lease improvements, and is called the lease improvement. And what then standard says how you deal with that how to depreciate that. So what we do, we need to depreciate in the and depreciation would be the depreciation would be in the lesser of lease life, lease term, and useful life of that particular assets you a particular improvement you have made. Let's take example of one office premises you have taken on lease for the 5 year, and one office cabin you have constructed, or some cafeteria you have constructed there. The life of that assets you have constructed is more than the actual lease life. Then you need to depreciate, still you need to depreciate that cafeteria and that improvement you have made into the lease term, and that is your 5 year of lease term. So that is the main that is the main term standard mention is leisure of the lease term, or the useful life of the particular assets you need to depreciate that leasehold improvements. Over to you, Astaji.
Thank you.
Now Sharmaji here. Suppose that lease agreement is generally for 11 months.
Yes.
And that's renewed on year-to-year basis.
Yes.
So then, how to do that?
Yes, sir. So we have seen the many similar cases also, that companies does the arrangement of recurring leases. So then what we does, the management intention to renew for the period of 5 years, 6 year, 7 year, 10 year. So business is going on process. So what we does, we depreciate that particular asset if that having a significant cost in that particular leasehold improvement. Then we depreciate over the period of that life of that particular asset.
Now here it could be that whatever the leasehold improvements are there, which could include not merely say the structural changes, but it could be including furniture fixtures also. So should the company bifurcate all those expenditures that have been done into leasehold improvements, furniture, fixture, plant, machinery, wherever it is required, plant. So it should do it like that, or everything should be into the leasehold improvements.
Yes, if sir, if it is related to the improvement, leasehold improvement, then it should be bifurcated into the leasehold improvement category, and depreciate in under that leasehold improvement category.
Oh, it could be when I'm doing it, I'll be putting certain almiras, certain partitions, certain table chairs, and all those things. So
okay, so those assets are in that particular category, because we can remove as it is in the conditions when we move to the new offices. So these will be classified in that particular category.
Great.
Thank you, Pramodji and B.L. Sharmaji. Moving on further, Pramodji, I have a question for you. In case of a tangible asset, in respect of which some duties were paid at the time of acquisition, now the duties have been refunded as per the applicable laws. What will be the applicable accounting treatment in such a scenario?
Here, in case the duties which are a part of the cost of the plant, only then the issue will arise.
Yeah.
That duties have been refunded, there is no issue. But now here, when it is forming part of the cost and later on, there is a refund. So here there are two views, I would say. One is that my overall cost of the plant is reduced. So reduced in the next year, whenever the refund is accruing, you have to reduce it from the plant, the cost of the plant. Another view is that to the extent of the depreciation which is claimed on the portion of that duty. that portion you should charge it to the revenue, and the other portion which is still forming part of the cost of the property, plant and equipment, those should be reduced. I'll like to request Rajkumarji to put his views on the same.
Yeah. So I think, sir, in the interest of time, because we like to have some questions, sir, maybe. So just keeping it short, friends, see, the cost includes the duty. So at the time of initial item, initial recognition, what you would have done is plant and machinery 1 lakh, 18,000 rupees, maybe the duty on it, or 20,000 rupees duty on it, and you get 120. Now on 120, you do the depreciation if it is not claimable. Now say suppose if it is claimable or mod weighted or what you call credit, then it is a different thought process. Otherwise, you would have added to the plant and machinery. Now at the same time, if you have claimed and there is some appeal or something pending, and after 5 years you get it. Now basically, see, in substance, what should have happened is you would have charged depreciation on 1,20,000 rupees. If say suppose the useful life is 10 years, already that component of the item, component of that PPE, out of that 20,000, probably 50% would have been charged to the P&L and only 10,000 would have remained. So my view would, if there is not any specific recital to it, but probably one of the possibility could be you reduce it the entire amount. That can also be done. There is no bar on it, or you can reduce the proportionate amount based on that. So either of them can be done, and maybe a more related standards like provisions and other standards, maybe we can work out on it.
Ind AS and AS doesn't have a specific provision on.
Yes. Asta, maybe we can now ask for the question because we are already.
Yes. So I was just about to share the questions that have been posed by our professional members. So we have a question by Manish Upnejaji from Delhi. So he's given a scenario wherein at the time of acquisition of machinery, the government had levied a road tax and it was capitalized along with the asset. And the entity charged depreciation on the value of the machinery, including the road tax as well. Parallelly, they filed a writ petition with the High Court to challenge the levy of road tax. Now, a few years later, they won the case and the entity received the refund of the road tax along with interest. So now his question is, it's related to the previous question only, but what about the depreciation bit? Will it be reversed? How will the accounting be done in this scenario? It's an open question for all the panelists.
So I think I'll take the lead. I think we have sufficiently dealt with this. See, one is the accounting aspect. So if there is nothing specific given, the first possibility that looks like is a very easy possibility that if you have refund, take it to the P&L. And of course, if it is with interest, let me tell you, there is no question on the interest. Interest would be charged or maybe credited to the P&L account. So that is out of question. With regards to the basic duty, there could be 2-3 options. One is you directly charged, you directly credit and pay tax on it, income tax on it, and what have been added to this. But that is if the amount is material, that would not give a correct picture for that particular item. So therefore, I think both the other situation we have already dealt in the last questions. And if the panelist wants, he can write to us again with more particulars. We can share with our thought process.
Okay. Our next question is from Mr. A. John. He's saying that a company has a self-generated machine which they give for 5-year lease and can be extended for another 5 period upon small repairs. The lease amount is nil, but they need to buy a particular amount of stock from the company in each year. The company capitalizes the same and depreciates it by giving the useful life of 6.7 years. Is the company following the accounting standard correctly in such a scenario?
I think this is one of the items. Maybe Sharmaji, I think you can answer this.
So could you repeat the question, Astaji?
Yeah, I'll repeat it again. The company has a self-generated machine which they've given for 5-year lease, and it can be extended for another 5 years upon small repairs. The lease amount is nil, but they are required to buy a particular stock from the company in each year. the company capitalizes and depreciates it as per the useful life of 6 to 7 years. Mr. John wants to know if the accounting treatment is done correctly by the company or not in this case.
No, because if the intention of the management is to that further extension is the extension right is with the management, to extension right of the renewal right with the management, then they can charge the depreciation in the useful life of the machinery, and that they have estimated is 6.5 years is correct if they have the right to renew that lease.
Okay. Next question is from Srini Vasalu. Based on provision, the asset is capitalized and depreciated. Subsequently, the actuals are reduced from the provision. Consequently, the negative price adjustment has to be done in gross block in subsequent year. So, how to calculate depreciation from the date of original date of commissioning or for the balance period?
Okay, so Asta, this question has a lot of elements. It has a different aspect altogether. Let me first tell you. The AS has a provision that every year you have to look at the residual value and you have to look at the useful life of the asset. So even if there is any adjustment in useful life or the residual value, normally it would not happen in 1 year. If it would have happened in 1 year, it would be an impairment rather than an issue of depreciation or the actual cost or the written down value. Say, let us take whatever the items that are given by our fellow member. If let us take it, that is the right position. The other problem in this is you cannot have any asset with a negative value. So actually, it has to be adjusted then and there. The negative value, how PP can have a negative value, then that could be a possibility when probably the residual value is more than whatever the carrying value is. In that case, the AS prescribes that in that particular year, you have to do the adjustment and it cannot exceed the residual value. So balance, you have to again do it in the P&L account. I think these are the items that, so in nutshell, the negative amount or whatever the amounts are there, they have to be adjusted into the PL and it cannot be a negative.
Okay. CABL Sharma ji, you have any opinion on this question?
No, I'm agree in line with Rajkumar sir as rightly mentioned.
Okay, great. So our next question is from CA Surana. Whether the fee for obtaining permission for building on land and other similar expenses will be capitalized or charged to revenue, where the company decides to abandon the original plan and sell the land without any actual development on it.
So, fee paid to
for commissioning, like for obtaining permission related to the land or the building that was constructed on the land, but later on they deferred the plans and did not actually materialize it.
So it means the machine that land which they have bought is still the intended use not taken into the intended use.
Yes.
So it was not capitalized that time.
No, so initially it was capitalized, but later on when they deferred the plan, it should be reversed, right?
Yes, definitely.
Okay.
Here, the question is that the land was already capitalized.
But
yes.
And thereafter, for the building, they applied for certain charges
Permission.
like sewerage, permissions and others.
No, but yes, sir. So that capitalization itself is not the correct which they have done because
there are two things. No, there are two things. First of all, it may have been into capital WIP. Yes. Land must have been capitalized.
Yes.
But the other costs related to building may have been on the capital WIP.
CWIP. Yes, sir.
Now the issue here could be that when they have sold that land, whether they have sold those permissions which they have applied for according to that or not. So when there is a derecognition of the land, so according to facts, it will have to be seen. Land could be separate and the capital WIP could be separate also.
Separate altogether.
And if it is not, they have to apply it separately or it is rejected, then it will be charged out to the PI. What I feel.
I think that's a right thought. I think to take it from, and maybe the year in which it is done and maybe the future year, both the items would not be the one of the year.
Yeah.
And as we have seen in the earlier also, that componentization also, that while capitalizing the assets, we need to see both the different. One is land is the altogether is the different, and any further development which we are doing. So anything they are incurring for the further development, they need to keep it into the CV, because still there is no existence of the new asset in place. So that CV will get reversed later, as Pramod sir rightly mentioned.
And also the first question which was asked by Asta was regarding from NL John, that they self-constructed a plant and they leased it out. The lease charges are nil. But the obligation is that they'll have to purchase certain items from them. The question is that, okay, whatever the cost is, whether they would capitalize it, yes, there is not an issue. But the only issue is whether it would be depreciated or not. Now, for the income tax, it could be different. But when I talk about my books of account as per the application of the AS, when the asset is there and it is being used not by me but by others, I am not gaining out of it. I cannot say that it is my investment into that plant. So that becomes a very interesting question, that without any, though I am not using it, third party is using it. Yeah. I am not getting any revenue out of it. Depreciation I have to provide. In my view, depreciation is, because the flips of time, by used by a third party, not by me, the depreciation should be provided out there. Income tax is a separate issue out here. This is just my initial thoughts out here. Because the situation was very interesting, that's why I just thought to pitch in.
True, sir.
Thank you for your perspective, Pramodji. Next question. The control of a manufacturing company was taken over by bank under the Sarfazi Act due to the loans becoming NPA. The company later settled the loans with the banks and took back the control of its premises. But on getting back the physical control, the company found that few plant and machinery items were missing. The company also filed a legal suit against the bank for this loss. Now, how should the company disclose this in its annual accounts? Should the company write off the missing items, or the disclosure will suffice? Very interesting scenario.
Again, I found this is, as we discussed earlier, sir, the question and answers from all our fellow members are sometimes very, very interesting. See, one very fact, though I'm answering your question, but see, there are a lot of facts attached to each of very specific queries. So, to the best of our ability and understanding of the fact, we are just a small disclaimer, but actually it is. So, ideally, this is a case of impairment. Basically, you have to reduce the amount and then do it. The disclosure would not suffice. In case if you have any compensation later on, then it would go to the P&L. That is the, in theory, a right approach. So
I agree with that, Kumarji. It is the same case that the assets are stolen. Yes. It is as good as assets stolen, so the same accounting system should be followed in my view.
Okay, moving on further, there's a question posed by Mr. Sagar Vyas. In case of procurement of machinery at payment terms beyond normal credit terms, say 3 years, how should we determine the discount rate to arrive at the cash price equivalent or actual cost of the machinery? I'm not sure if this is a PP related question, but
no. Yeah, it is. It is.
Okay.
Ind AS.
So, if I take up the question, basically the principle that is prescribed is the cash equivalent. So, if I'm correctly understanding the question, all these adjustments, the procurement term and everything, you have to actually do the cash equivalent cost accounting. And if there is any interest component, then it has to be dealt in accordance to the related AS, like say for example borrowing cost. So with respect to getting whether it is a part of interest or not, you have to do the PV valuation and all the other valuation. And I think this is one of a few challenges in implementation of Ind.
Okay. Since we've already exceeded our time limit, we won't be able to take further questions, but the audience is welcome to submit the questions to the ASP and we can address them as and when required. So with this, we will come to the end of our webinar for today. I would request our chairman, CA Pramod Jain, to give vote of thanks.
Thank you, Asta. In fact, the session was very interesting and I enjoyed. I hope that both the panelists must have also enjoyed, and participants, of course, they must have gained out of it a lot. And we really appreciate the questions which have been asked by various participants, giving the practical aspects of certain issues, which makes the matter more interesting. In future, we will try and see that we are able to take more questions of the participants because the time is always short. So I really thank all of you, both the participants, both the panelists, Rajkumar Agarwal sir and B.L. Sharma sir, for sparing your time and sharing your vast knowledge with all the participants. And of course, CA Asta Gupta for moderating it so well, making it so lively, and putting the questions, taking the questions, generating of her own, and also of the members she asked. So I really thank all three of you. And I also thank the support staff of the Accounting Standard Board who have been doing a fantastic job, and also all the participants for hooking in. There are more than 1,100 participants who have joined as of now. So thanks to each and everyone. Thank you very much. Thank you.
Thank you.
Thank you.